Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we talk about the market news of the week. And this week, Robert, we have some more coronavirus updates, and we also got quite a lot of economic data this week. Overall, it was a pretty green week, although we ended down a little bit. On Monday, markets moved higher, partly due to analyst upgrades on Nike and Tesla. Tesla surged 20% in one day. And Monday also saw stronger than expected manufacturing numbers, which suggest that that sector may be starting to recover.
Yeah, and 20% for most stocks would be good, but for Tesla at its price point is amazing. And then Tuesday, the market moves sharply higher again as we got more good news for U.S. manufacturing, with factory orders growing more than twice as fast as analysts expected. Home prices posted solid 4% growth, an increase from 3.7% the previous month. We also got news that China's central bank may lower reserve requirements, cut interest rates, which would boost the Chinese economy, but also increase recession risk. Tesla also surged for a second day, gaining another 13.7%.
Yeah, it really, I mean, once a stock gets to that high a price point, like a 2% gain is a good gain. So for a stock that's that high, that's already at 100 PE to gain 20% in one day and then 13.7% in another day is pretty crazy. Wednesday, the indexes got another surge, taking the S&P 500 to fresh all-time highs, mostly due to rumors that scientists in the UK had made some kind of breakthrough on vaccine development that would drastically reduce the development time. The talk was that parts of the development process would be reduced from 2 to 3 years to 14 days. I haven't been able to confirm these rumors, and I also can't figure out who's actually doing this work. Is there a company that's involved in this development? And I also don't know, if parts of the development are going to be reduced in their development time. I mean, it still may take 2 to 3 years to actually develop the vaccine because other parts of the development may still take that long. So I'm not really sure what this means, but the market reacted very positively to it. S&P 500 moving up pretty strongly. China is also doing clinical trials on an antiviral drug developed by Gilead Sciences that's supposedly highly effective. Gilead, from the reports I read, isn't actually going to make any money off of providing drugs for coronavirus treatment. But they did, I think, report fairly positive earnings this week. So they moved up over the course of the week. I actually made some money in Gilead this week. We also got strong payroll data this week, or on Wednesday, which may have helped juice the market a little bit. But some other economic numbers that came out on Wednesday were not as good. We got trade deficit, mortgage applications, and crude oil inventory numbers that all came in a little weaker than expected. And Tesla on Wednesday plummeted over 17%, erasing much of its gain from the previous 2 days. Tesla made what's called a parabolic move, which is where the more the stock goes up, the faster it goes up. It accelerates as it increases until the chart looks almost vertical. And typically a parabolic move like that is followed by a pretty steep collapse. It's basically a product of the market just getting a little too excited. Everybody gets greedy. Everybody gets a little crazy, and everybody wants to jump on the bandwagon. And then all of a sudden they all come to their senses and realize, what have I done? And the stock plummets. So this is something that we've seen multiple times in Bitcoin, that we've seen in Overstock.com, Tesla. It happens a lot in very hyped stocks that people have a kind of religious faith in. So keep an eye out for those and don't bandwagon when something makes a parabolic move like that.
And I think it's also that when people saw it was getting close to that $1,000 mark, a lot of investors were like, all right, eject. And they wanted to make sure that they got their money out because they knew if it hit that $1,000 mark that other people were going to bail. So people wanted to ring the register before everyone else did. So I think that's part of the reason why it reached close to that $1,000 level and then just plummeted on Wednesday.
Yeah, it didn't quite get there. Yeah, I think you're right.
And Thursday, we posted another small gain after China announced that it was cutting tariffs on U.S. goods in half in accordance with its Phase 1 agreement with the United States. We also got better than expected productivity numbers and jobless claims, but more than twice as many layoffs in January than the previous month. And Funko, I was actually texting Chris this week about it. That company that produces those pop figures you see in almost every retail store. It tanked on lower guidance due to a poor holiday season. The stock lost nearly 40% overnight, which for a stock that was trading around $15 for it to get to around the $8 mark, it's really bad for that stock in terms of value for the company overall, and also doesn't look good for that part of the market. And then Friday, the indexes pulled back despite a much stronger than expected jobs number for January, with when the economy added 225,000 rather than 155,000 jobs. Consumer credit growth also came in much higher than expected. Mostly the pullback happened because of concern about the economic impact of coronavirus. One analyst suggests China's GDP growth might be 0 this year, and JP Morgan projected that China GDP growth might fall from 6% last year to just 1% this year.
Yeah, and China is a huge segment of the global economy. So if China's GDP growth goes from 6% to 0% or 1%, like that would have a huge impact on global markets. So it wouldn't just be China that is affected. Even if this coronavirus gets contained in China and does not, significantly spread outside of China, it's still that economic impact would reverberate throughout the entire global economy, So that's a really big deal. And if these analysts are correct that China's GDP is going to take that big hit, that's not good news for any part of the global economy. I made my own analysis on Friday without knowing about these analyst reports, and I came to a similar conclusion, although a little bit more moderate in my numbers. I projected that the number of coronavirus cases may grow from about 32,000 right now to about 190,000 by the end of February, and that's just based on like a best fit curve. That may be, there may be wild variations, wild changes in that by the end of February, depending how quarantines change and, where the virus spreads to next. But that's the fit looks pretty good on that curve so far. And I also projected, based on studies of Spanish flu that scientists have made, that we may see at least a 1% reduction in global GDP growth and a large increase in poverty rates if this thing becomes a global pandemic. There was a study on Spanish flu in Sweden. Spanish flu in Sweden had basically similar mortality rates, about a 2% mortality rate in Sweden, and also spread at about the same rate that coronavirus has been spreading. So it's pretty comparable to coronavirus in terms of its infectiousness and its mortality rate. And this is what they found, that it had about a 1% impact on capital returns, and also that poverty rates in counties that were hardest hit were about 11% more affected. That there was about an 11% increase in like the hardest hit counties versus the least hard hit counties. And that basically was the result of like children's parents dying and leaving a lot of orphans. So, could have a pretty significant economic impact. I think significant increases in poverty rates could hit banks pretty hard. Banks are highly exposed right now to subprime mortgages, subprime lending. So anything that causes the economy to slow down poses a significant risk of triggering a cascade of defaults like we saw in 2008 heading into the recession there, because, of course, the numbers of risky loans and risky mortgages are actually higher right now than they were in 2007 before that recession. So there's a lot of economic risk out there in the economy. We've been borrowing money like crazy, hand over fist. We've got low interest rates, low lending standards in the private sector. So we've got a lot of risky private borrowing, and the federal government has also been borrowing. We're running $1 trillion deficit right now in an economic boom. And if there were to be a recession, you'd see that deficit go through the roof because, of course, government revenues go down. So it doesn't leave the government a lot of room for stimulus spending or for lowering interest rates further in order to stimulate the economy in the event of a recession. So we've got to be, I think, pretty careful going into this year, because if coronavirus has anything like the kind of economic impact that these analysts are predicting, there's a lot of risk of recession this year. I think prediction markets right now are putting the risk of recession in Trump's first term at something like 22%. So that's almost a 1 in 4 chance that we go into a recession by November. And the folks who play those prediction markets are really smart people, so I think that they know what they're talking about. So I actually am mostly out of the market right now, Robert. I drew my holdings down to something like 75% cash and just about 25% in the market. Because I see signs that we may be making a top. Let's talk stocks that we watched last week. Why don't you go ahead and go first?
All right. So WWE, they kept tumbling, and I luckily, as I mentioned last week, I bought a small position on Friday, and Monday morning I saw that it was still tumbling, so I just ejected. I only took a small loss, so I luckily got out before it got worse, which it keeps tumbling this week, and it doesn't seem to have found its bottom yet. After a really poor quarterly earnings call, a lot of people are very skeptical of the leadership behind WWE with those two executives that were abruptly leaving the company. And also, it was also released in news that if Vince McMahon, the current CEO, were to suddenly pass or something were to happen to him where he was unable to perform his duties as CEO, there is no current line of succession in the company. And his son-in-law, which everyone assumes is going to be the next de facto leader of the company, they're saying that he wouldn't really be accepted by Wall Street just for the fact that he doesn't have that background acumen that most CEOs have. So there's a lot of negative news around WWE, and I'm still waiting to see the bottom of this because there is a lot of value in the stock, and I believe they can turn it around. They just have to have the right people in place in leadership, and if they replace those two people with strong candidates, I think they have a really good chance at turning the ship around. And then Viacom CBS, it jumped on news. It will be unveiling its own streaming service after its quarterly earnings reports in a couple of weeks. It owns some of the more popular networks such as Comedy Central, Nickelodeon, BET, and movie studio Paramount Pictures. They also own studios like MTV and also I forget the other channels, but they own quite a bit. And I believe, like, for nostalgia purposes, they probably will be make a significant impact on the streaming market, but I don't think they're going to be as popular as Disney Plus. Disney Plus announced this week that they did reach 28 million subscribers when it was only expected to hit 25. So the market is still huge for streaming right now. So Ford is announcing its COO is retiring and will be replaced by Jim Farley, a former fixed op executive within Ford. He led the European division. The stock tumbled close to 10% on a poor quarterly earnings report, as Ford is very, very, very slowly going through a restructuring under the CEO of Ford. He's been restructuring the company for the future for the last 3 years. I think Jim Farley is a good pick for a COO to replace the retiring COO. Just for the fact that he sees a lot of future in technology, and I believe he's a better fit than the current CEO. But the stock right now is it's a little over $8 a share, so it's a good price point, especially if you like dividends. They do pay quite an attractive dividend, and you can get quite a lot of Ford stock for pretty cheap. But don't expect a lot of growth in the interim. It's probably, or in the short term, it'll probably be a long time before they turn much more profitable. They did recently announce during the Super Bowl that they're going to have an all-electric Ford Mustang, which for the Ford Mustang market, I'm not sure if that's going to do well with that type of target demographic, because those, I'm not going to say that they wouldn't appreciate a electric vehicle, but I'm pretty sure most people who drive Mustangs just like to hear the motor.
Yeah, that seems like a bit of a product mismatch. Not sure how good an idea that was.
But we'll see. I mean, we'll see if they decide to add like some sort of sound mechanism to make the motor sound, or like it'll probably be like a flip switch where it's like you can actually hear the motor now, because anyone who's been around like a Tesla, you will know how infinitely silent those things are. Like those things can creep up on you. And Priuses before that were pretty quiet. These are like Teslas are a lot more quiet than Priuses. So, and the last stock I've been watching is, of course, Activision Blizzard. They announced very strong numbers during their conference call. I actually listened in on this one. The stock moved slightly higher, but it'll be interesting to see if the stock continues its trend of the last year of moving higher. It's posted strong MAU, which is monthly active users. They did see a lot of growth in that, especially with successful launches of both the latest in the Call of Duty series, Modern Warfare, where they walked away from the standard battle pass model and went to just a straight microtransaction model. And they also released Call of Duty Mobile, which is basically rivaling that of some of their other mobile platforms or mobile IPs, such as Candy Crush Saga. They're actually doing quite well in that market. So definitely, I'm hoping Activision Blizzard will keep its trend upwards. I did take some of my money out of Activision Blizzard. I took 25% out of the stock I had invested in there, and just waiting to see how the rest of it goes. What stocks were you watching this week, Chris?
Well, last week I called out Baidu, Grupo Financiero Galicia, which is an Argentinian bank, and AbbVie, which is a pharmaceutical company. Baidu and Grupo Financiero Galicia both ended the week up slightly, but nothing to really get excited about. AbbVie, however, gained 13% this week, and partly that's because its earnings beat analyst expectations, thanks to strong sales of Humira, which is an autoimmune drug. And partly I think it's also because AbbVie's HIV drug Eluvia is being used in China to treat patients with coronavirus. So as coronavirus spreads, there is the potential for a boost in sales of Eluvia as well. So strong results, strong performance from AbbVie this week. A couple of the other long-term things that I've been holding also reported really great earnings this week. Curo and PennyMac Financial Services both had really great weeks. So overall, I had a really green week. It was a great week for me. What stocks are you watching this coming week, Robert?
So this week I'll be watching Lyft, as its major competitor Uber recently announced that they should reach profitability at the end of Q4 of 2020, which is 1 year ahead of their previous estimates. Lyft, however, has been taking a different approach to increasing revenue with a subscription model they launched in October, so we will kind of get a glimpse of that, of how successful it is on their earnings report. They announced their earnings after the close on Tuesday. Under Armour reports earnings before the stock market opens on Tuesday, and I anticipate it to lower guidance for 2020 amid the coronavirus outbreak in China. China is the fastest growing region among similar retailers like Nike and Adidas. However, only 15% of production for Under Armour is performed in China. So they're not going to have an impact. I don't think they're going to have as big of an impact in terms of production, but definitely sales will be lagging, I believe. So I'll probably be in a holding pattern before taking any action on Under Armour until coronavirus has been subsided. So it'll probably be a while before I actually buy into Under Armour. Unless there's some report out that it comes out that they're doing well in another market. And then CVS, they also report this week, and last time we talked about CVS, it soared on the Walmart tailwind, and some analysts believe that it still has room to grow, especially since it's been taking some small losses since the beginning of the year.
Yeah, CVS definitely had a pretty good week this week. Watched it climb quite a bit. And that's another one of those long-term stocks that I have been holding for quite a while. So, yeah, great week for some of those undervalued stocks for sure. This week, I will be continuing to watch AbbVie, which is that pharmaceutical company I mentioned. I think that they could continue to rise amidst all of this coronavirus fear next week. I'm also interested in Curo and PennyMac Financial. As I already mentioned, these are stocks that I've been holding long term because they were already extremely undervalued and fast-growing companies going into their earnings reports. And then they both, PennyMac Financial killed it on its earnings report, significantly beat on both earnings and revenue, and also raised its full-year guidance. So extremely strong results from PennyMac, and it shot up quite a bit on Friday. And Curo Holdings Group, it reported pretty mixed results on its earnings report, but it introduced its first ever dividend. It introduced basically a little over 2% dividend. From previously, it was paying no dividend at all. And the thing about a stock that introduces its first ever dividend is that it starts to trade at a much higher PE than it has traded at in the past. So in the past, I think this is traded at between like 3 and 4 forward PE. And I think it could now head upward toward like 10 to 15 forward PE, which would imply like a tripling of the share price. So that it's got a lot of potential upside in the long term, I think, just as a result of now having become a dividend stock where it wasn't before. So really, I think a lot of upside potential in Curo. The risk is that these are lenders. Curo and PennyMac are both lenders. And there's, of course, the recession risk this year to lenders, especially to small subprime lenders. If a lot of mortgages were starting to go into default, that could really affect stocks like these. So I think both of these stocks are attractive, but both of them are also very risky. As I said, I am about 75% in cash right now. It's probably going to be a long time before I go back to a higher allocation of stocks because I see a lot of risk this year from coronavirus and from all of this risky lending out there in the market. So probably what I'm going to do is play small option positions on these stocks. I've got some calls on them, and I'll be holding them, through like February, March, as long as they don't experience a major downturn. That allows me to really limit my risk. What I like to do is I like to buy the really cheap calls, like the $10 calls that expire in February for a much higher strike price, and then if the share price were to move up $2. Those $10 calls could become worth, $100. They could become $100 calls. So that way, I'm not spending a lot of money. I'm not risking a lot of money, but I do have quite a bit of potential profit there. So playing options is kind of a nice way to limit your risk in the market. If you don't want to have, tens of thousands of dollars out there, you can still make pretty significant profits on fairly small initial investments if you've got a really good prospect. So I think that's what I'm going to do. I should emphasize those are both longer term plays. They might drop this week because both of them already shot up quite a bit after earnings. So you may want to wait for a dip if you're looking to enter these two stocks, Curo and PennyMac Financial. And again, as I said, they're both financial stocks, and so they have a lot of recession risk. I think AbbVie this week probably looks like a stronger short-term play. It has moved up quite a bit, but it's moved up through a critical resistance level. And so I think that we may get a continuation this week, especially since this is one that may actually benefit from coronavirus rather than being harmed by it. So definitely a risky time out there, but I think there are opportunities, Robert. And I think, the Activision play is probably a good one, given how people are going to be staying at home, feeling bored, playing video games. So yep. I think that's probably a good one to watch as well. So, well, folks, if you enjoyed the podcast, if you heard anything that you found beneficial, please give us a like, a share, a comment, a follow. We've got links underneath the YouTube video for our Facebook and Twitter feed. I posted this week on our Twitter page my graph of a possible projection of coronavirus numbers in the next month. So go check that out. I also posted a link to my analysis of the recession risk this year, so you can go check that out on our Twitter page. Give those a like, give us a follow on Twitter. And we also have a link under the YouTube video for a referral link to Webull. If you would like to go trade, Webull now has options. So if you want to play, calls and puts, you could go over to Webull and sign up for their options trading. But all you have to do is just open a Webull account, deposit $100, and you get a free stock. We get a free stock. That helps support the podcast. And it's great for you, too, because who doesn't like free stuff? Thanks so much, and we will see you next week at the zoo.
See you.